Where's Robot Lady? There she is. Hello, everyone. Welcome to a special April 14th edition of the Scientific Governance and Risk meeting. This one is light on the governance, heavy on the risk. We're going to hear from Cyrus and Vishesh today as they drop science. There's a significant, huge amount of work that's been happening in the background from the risk team over the course of the last few months and years maybe, almost. And today we're going to start walking through that stuff. I'm going to fade into the background almost immediately. Cyrus asked me to come along to help moderate. I'm reasonably sure I'm only here to kick 12-year-olds off once they find out where our Zoom meeting is. So I'm going to hand it off to Cyrus immediately and let him set the context for everybody. Cyrus.
Cool. Yeah. First off, Rich, I'm pretty sure you have to be at every governance call, right? These are not optional.
And the authority of my position, I guess. Okay.
Okay. So thanks everybody for joining governance call outside of the regular circuit. I think we may see more of this type of thing in the coming months as we start to tackle a whole bunch of new initiatives. So today, I think we're just going to quickly discuss a minor SCD shutdown topic. And then afterwards, we're going to get back into some risk discussions. A few weeks ago, we started some collateral risk presentations. I think we gave one presentation before Black Thursday happened and things got a little bit sidetracked. So instead of reverting back to the 30-minute time slot per week cadence that we had before, we just thought it'd be easier to just hammer these out in a few longer sessions, record them, put them up. Hopefully they will be a little bit more coherent and they'll flow better and so forth. So yeah, before we jump into the risk stuff, Kurt was just talking about the possibility of adding a delay into SCD shutdown after the spell is cast. Essentially, this would set the actual shutdown to occur at a specific timestamp, and this would make it significantly easier for the ecosystem, for the community, for integration partners to manage their UIs and so forth, and help ensure a smoother wind down. But I think there's maybe a quick 5-minute discussion that should go into this. Kurt, did I sum that up?
Yeah, I couldn't have said it better myself. You know, basically the idea is just that whenever the executive goes out, the code that implements it will have some, like, you know, this can't be cast, say, you know, before May 1st, whatever. You know, pick what, you know, the idea here is to pick that date, which, you know, some consideration should go into maybe how long the delay should be, because I don't know if we know necessarily when we're also going to, like, have the executive passed or floated out, but you just want to remove that dependence of, you know, the spell can pass at any time, and just give a predictable, you know, shutdown date and time.
Well, I think this is a conversation that can also.
In response to a comment in the chat where it says if this part doesn't pass, it will muck up the whole time thing and make Maker look really bad from a PR perspective, we're referring to, you know, if we say the system's going to shut down at X date, but then the spell to actually shut it down at X date doesn't pass, it looks a little weird. I think the answer to that is you just do the messaging of, say, okay, hey, here's an executive spell to shut down, you know, at this date, that's a month and a half in the future, and then you only announce the shutdown is happening if that passes. So I think that's just a matter of order of operations of how you announce stuff, which is another good argument for having, you know, a fairly long delay, so that after you know, once you've gotten consensus and actually passed the vote, then you can still announce it with plenty of lead time for people to prepare.
All right, sorry about that, guys. I don't know where I cut off, but Vishesh, if you're there, do you want to do the screen share? All right. So today is going to is there an echo for anybody else?
Yeah, I'm getting an echo.
Yeah, I think Vishesh, maybe your microphone's on. Cyrus, can you say something?
Yeah. All right. We're going to start off by quickly reviewing the few slides we did a few weeks ago. Probably just easier to start fresh. But first, we are going to read a little bit of a disclaimer, which is likely to be become a standard on these risk calls. Just something the folks at the foundation would like me to read. Can you jump to the next slide, Vishesh? All right, so this communication is provided for information purposes only. The views expressed here are those of the individual Maker Foundation Maker personnel quoted or who present said materials and are not the views of Maker or its affiliates. The communication has been prepared based upon information, including market prices, data, and other information from sources believed to be reliable. But Maker has not independently verified such information and makes no representations about the enduring accuracy of the information or its appropriateness for a given situation. This content is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. You should consult your own advisors as to those matters. References to any digital assets and the use of finance-related terminology are for illustrative purposes only and do not constitute any recommendation for any action or an offer to provide investment advisory services. This content is not directed at nor intended for use by the MakerDAO community and may not under any circumstances be relied upon when making a decision to purchase any other digital asset referenced herein. The digital assets referenced herein currently face an uncertain regulatory landscape in not only the United States, but also in many foreign jurisdictions, including but not limited to the UK, European Union, Singapore, Korea, Japan, and China. The legal and regulatory risks inherent in referenced digital assets are not the subject of this content. For guidance regarding the possibility of said risks, one should consult with his or her own appropriate legal and or regulatory counsel. Charts and graphs provided within are for informational purposes solely and should not be relied upon when making any decision. The content speaks only as of the date indicated. Any projections, estimates, forecasts, targets, prospects, and or opinions expressed in these materials are subject to change without notice and may differ or be contrary to opinions expressed by others. All right, you guys all get that? Cool. Let's get started then. Next slide, please, Vishesh. All right, so today we're going to do an overview of collateral risk and risk parameters. Next slide. One of the core objectives for MakerDAO has always been collateral onboarding. Collateral onboarding is important for scale and growth, monetary policy, and other objectives. Adding new collateral, of course, requires proper risk management, which can be quite difficult, especially in the context of decentralized risk and decentralized governance and all that. So in an effort to bootstrap that process, myself and a few others, Vishesh, Primoz, and Marco, have created a template for risk. Our goal is to create tooling that can hopefully integrate well with the community and that governance can basically help drive this whole thing forward. And we can start adding new collateral types. We can start working with the MIPS process. and we can just start helping Maker grow and scale and all that fun stuff. Next slide. Just a few things the community can expect from us in terms of deliverables. Primarily, a quantitative framework for evaluating risk. This is in conjunction with monetary policy. It's really an extension, not a replacement of any sort. So basically, up till now, a lot of the risk work the community has been doing for the past couple of years has been primarily focused on monetary policy, and there's now going to be a collateral risk portion as well. As we'll soon see, we'd like to have other teams come in and look at our work as well, improve it, critique it, all that stuff. We'd love to have people come in and just audit it, pick it apart, and so forth. And the idea really is to kind of help get this, get engagement going amongst new prospective risk teams. Eventually, we hope to see a network of independent risk teams all collaborating towards Maker Risk. Next slide. And just to manage expectations, especially these days when there's a lot of market volatility and emotional volatility as well, it's fair to say that there are a number of assumptions baked into any risk model, really, and Maker is no exception. So there isn't really going to be a magic 8-ball on what policy should look like. And in fact, some decisions, it's not really even appropriate for the risk team to call the shots. A lot of these trade-offs don't have clear answers, and there'll need to be a bit of community input in terms of direction. Over time, though, the expectation is that there'll be plenty of risk teams, and this process should be, decentralized, and it should be efficient, and it should hopefully work out well. Just imagine if we had 20 Visheshes instead of just one. Maker would soon take over the world. Yeah, next slide. Okay, so at this point, I think I'm going to let Vishesh take over for a little bit. We'll hear from him on Maker Risk.
Okay, can you hear me all right?
Yes.
Okay. So yeah, I mean, just to level set, there's two big parts to the Maker system. One is the DAI token, the other is the vaults. And these two systems sort of work in an interrelated way.
Vishesh,
So
sorry
the DAI,
to cut you off.
yeah.
There's still a bit of an echo coming from you. Do you think there's a way to deal with that, you think?
See. How is it now? Is echo better?
It's better.
Okay. So yeah, I was just saying there's two portions to the system. So the DAI token and the vaults. As far as the DAI token, obviously the goal is to maintain a target price pegged at $1. The risks associated with it, so DAI holders bear some degree of monetary policy risk, as well as some degree of credit risk, because the vault system is sort of backing the functionality of the DAI token. The vaults, on the other hand, so they are able to generate DAI, and they're able to get access to leverage using that. But in turn, the MKR holders are bearing a credit risk for these vaults, And they also govern this risk by having control over the ability to set risk parameters. And if a vault is liquidated, then the system will attempt to recover DAI through a collateral auction, or if that doesn't work, then MKR dilution. So we have multiple parties at play here. They're all sort of connected in the ecosystem that is MakerDAO. So in general, I think, when managing the system, you try to identify your targets and goals, and you identify the problems that you need to solve in order to achieve those goals. So for the DAI token, as kind of been stated before, the goal is to grow the usage and the overall supply of DAI, but do it in a sustainable way where it's scaling to demand and you're maintaining meaningful transaction value. As far as the peg itself, the goal is to obviously balance supply and demand and straddle the line of that target price. The levers that are available to do this are the monetary policy levers like the DSR, stability fee, debt ceiling, etc. And the general approach so far has been to adjust those rates appropriately, and use the monetary policy levers in a way that helps to maintain lower supply when there's a depressed price, and a way to increase supply when there's a elevated price. The vaults. So the general approach is to one, maximize the value for MKR holders. So value being obviously a net function of sort of any flow of value received from, say, liquidation, stability fees, things like that, but also the risks associated with it in terms of credit risk, insolvency risk, etc. So you have to balance that equation as well, which means the most important and biggest missing step in all of this, at least in terms of a lot of the conversations that have been had so far about Maker, are those risks. And so that's part of the goal of some of this work, is to quantify and ideally minimize the risks associated. So one, you have to figure out what is an appropriate debt ceiling. You have to quantify MKR dilution, what's the risk associated there. You saw a lot of this with the auctions and sales that occurred previously. You have to figure out what's an appropriate surplus buffer for the surplus itself, and then also buffer for things like debt ceilings. You have to identify, collateral types, what's an appropriate collateral to add, how much risk is associated with that collateral, and what parameters you need to set in order to appropriately adjust for that risk. Plus, obviously, just considering macro level risks as well in terms of diversifying your collateral asset portfolio, et cetera, so you don't have just a bunch of tail risk correlated assets, for example. So yeah, where does this risk specifically come from? So when you talk about gains and losses for MKR holders, one thing is, so these vaults are generating value for MKR holders through stability fees, and these liquidation penalties as well can, in an ideal system, serve to add to the surplus buffer. The stability fees accrue over time and are collected upon repayment of DAI. So that's sort of a time-based function. And when vaults are liquidated at above 100% collateralization, there's a liquidation penalty that is extracted from that sale. And losses occur when vaults are liquidated below 100% collateralization. So effectively, if there's not enough money to back the debt. And MKR at the last resort is diluted to pay for that difference. In terms of quantifying and minimizing the insolvency risk, so basically, MKR being the policy of last resort here, if it is unable to cover the outstanding debt, the whole system would effectively be insolvent. At that point, likely emergency shutdown. Well, at that point, or potentially before, likely emergency shutdown would be triggered, and the remaining collateral will be distributed to die holders, sort of in the worst case scenario. So how do you start to think about this? What does this all mean? How do you organize this information? Basically, there's two sides of the coin: managing monetary policy and managing collateral risk. The vaults themselves as well pose a degree of credit risk, though that's primarily derived from collateral risk. What are the questions that this type of work is seeking to answer? Well, one, you want to try to identify an appropriate stability fee given a set of parameters. You want to try to identify sustainable debt ceilings, and you want to set the parameters such that it's conducive to the growth of the system as well. So in general, how do you go about doing this work and starting to answer these questions? Well, one, you can simulate how you expect these liquidations to occur and how you expect them to occur. So, is in a stressed time period, would the whole collateral asset portfolio get liquidated at 140%, 130%, 120%, 90%, 40%? These are the kinds of questions that you can start to try to model and answer. And basically that is the prime step in identifying gains or losses for MKR holders in terms of the value that's recovered from vault collaterals post-liquidation. And then you also want to produce basically a distribution of these gains or losses over time. And then you use that distribution to identify basically your worst tail cases and sort of your average cases. And then basically there's a bunch of traditional finance methodology that goes into identifying what do you do with that information once you have it. When you know, okay, you roughly expect to lose X amount on average, and in your worst cases, you probably expect to lose, Y amount in total sum. And those basically help identify your degree of exposure. And then the goal is to appropriately set parameters to adjust for that degree of exposure. So again, where does this risk come from? Where do these losses come from? Where do the gains come from? So basically, when these vaults are liquidated at 100% collateralization or lower, that generates losses. When vaults are generated or are liquidated between 100 and 150% collateralization, that generates gains. And then essentially when vaults are at above 150% collateralization, they're not liquidated, so it doesn't do anything from the system perspective and from MKR holder perspectives. The driver that sort of causes these fluctuations in collateralization ratios over time is primarily asset price. So in simple terms, with ETH as collateral, when ETH goes up and down, collateralization ratios go up and down, and that leads to liquidations. There's a lot more nuances to it than that, but that's the basic idea. So just running through a couple specific examples of where these kinds of losses and gains can come from. If you consider, a vault with 100 DAI debt with an ETH price of $200, that and one ETH in collateral, that vault's initially safe, so it's in this gray area. Let's say price falls by 33% to $133. That collateralization ratio has now dipped below the gray line, so it's unsafe and gets liquidated. But it is, sort of in the green area. So when it does get liquidated, you do have enough collateral in the vault such that Post liquidation, you're able to cover the debt and also generate some liquidation penalties as well. So this is a case where this generates gains. Now consider a case where same thing happens, similar vault setup. I need to make sure I don't say CDP. And that vault is initially safe, instantaneously drops to $60 ETH price, which means now it's below 150%, but it's also under collateralized. So when the entire 1 ETH is sold, even in the best case scenario, which assumes no slippage, you would only obtain 60 DAI, which means there's no liquidation penalties to be collected for the system, and MKR holders actually have to be diluted to make up, if there's no buffer to cover it, MKR holders have to be diluted to make up for the shortfall. So this was a case where you generate losses from purely dipping below into that red area. Now, consider a third case, which is a bit more of a gray area. So same setup, price drops by 50% overnight. Now, in this particular example, when you sell the 1 ETH at the new ETH price of $100, even though in theory, the system might be able to recover exactly what it needs to, you're not necessarily going to make up the full debt amount, because when these auctions occur, when DAI price fluctuates, when large quantities of collateral are being sold, in reality, you're not necessarily going to recover the full amount of the debt. And I've sort of talked about this idea of auction efficiency as well. It goes into this, where when you sell $1 worth of ETH, how many dollars do you actually recover in DAI? And that is not necessarily a one-to-one. Like I said, there's a lot of factors that go into where additional losses can come from. So in this particular example, you sold $100 worth of ETH, but due to inefficient auctions or due to price movements during auction, you only obtain 80 DAI. In this case, you don't have enough DAI to cover the debt, and you obviously don't have enough to generate any liquidation penalties. So in reality, the MKR holders have to make up the shortfall. So this is a case where you would have been in the green area, but due to reality and market conditions, you dip into the red area. So as an example of where I say there's nuances to this stuff. So yeah, like I said, asset price is the prime independent variable that's driving this. So as ETH price fluctuates, what you're going to see is fluctuations in collateralization ratios. So this is a sample simulation where, and it looks very similar to what you see in reality. So consider each of these red and green lines to be a different vault or a different group of vaults. And they all started at a particular collateralization ratio, sort of in a normal curve. And as this blue line, this ETH price fluctuated over time, these collateralization ratios also fluctuated over time. Not quite one-to-one. Like I said, there's nuances associated with this that I'll touch on, but they fluctuate. And when that ETH price drops significantly, some of them dip below into the under collateralized category, and this would generate liquidations. So there you precisely see a spike in liquidations at that particular drop. Now, obviously, this is a sample ETH price. This is not the actual ETH price history, in case somebody in the back of their head was thinking ETH is not worth $20. So to just touch on how this translates into gains and losses then. So like I said, these particular, if you consider these particular liquidations, some of these are below that 100 mark. So some of these are generating very real losses for MKR holders. Some of these are liquidated above, and are not generating losses and potentially liquidation penalties. And so essentially the net value during that liquidation event would, in this case, have been pretty significant losses. So this is generally the process that we're looking at, where you start with the asset price, back your way into the collateralization ratios, use those collateralization ratios to determine the amount of debt that's liquidated, and then based on the amount of debt that's liquidated at the particular collateralization ratios, it's a trivial calculation to say what are roughly the gains or losses from that liquidation event. The general approach that we're taking here is a Monte Carlo simulation. There's not a huge, long, 10-year robust price history for ETH as there are for some traditional assets. So you have to take different approaches when stress testing. Crypto lends itself well to Monte Carlo simulations, particularly because these are complex systems with a lot of nuances to them, and also because there's not strong, robust histories to just do simple historical analysis on. We have to get a little bit more in the weeds on it. And if anyone is not familiar, just in general, Monte Carlo simulation, this is a perfect example when you're trying to figure out how big a particular circle is, bound it inside of a square, throw millions of tiny darts at it, and count up the ones that hit in the circle versus the ones that don't, and you'll determine the area of the circle relative to the square. So basically that's saying you run a bunch of simulations like we would do for asset prices. So you could consider each of these lines to be a different world in which ETH moved in a particular way, or the collateral asset moved in a particular way. And then you calculate your values for every one of these lines, and then you do your averages and collect your tail events. And that's a pretty well accepted methodology for stress testing in traditional finance, especially when it comes to things that asset prices that fluctuate in a sort of random walk approach, which traditionally is, you can think of stocks as an example. In this case, we're looking at crypto assets. So you use those lines, you determine a distribution over a number of different simulations. This particular graph shows just 100. You figure out your average percentage losses for each of those simulations, look at the distribution of them, slice it up differently, and you learn different things from, say, the mean versus the tail, etc. But this is the main unit of data that you're using to get your learnings off of. Yeah, and then you can start to talk about how to analyze that distribution. Like I said, there are different methods of carving up that distribution to learn different things. So you can talk about sort of expected losses, unexpected losses, value at risk. Cyrus, did you want to touch on these?
Yeah, I'll chime in here for a bit. If you can maybe mute yourself again, though. Sorry. All right, so yeah, that last slide, or also the chart here, is a picture of a hypothetical probability distribution of losses. It simply says how likely a particular loss is. Generally speaking, the majority of losses are small, and then you have some extreme losses at the end, the shaded region, which are large losses that are very infrequent. People tend to call these tail losses and so forth. You can do a couple cool things with a distribution like this, or a few basic metrics. The most simplest one is just merely the average or the mean of this distribution, which is called the expected loss. This one, the expected loss, is important because, well, it's what you're it's what you're expected to lose. And so you have to be sure that you can cover these. These are losses that are, by definition, not a surprise to anybody. And keep in mind that these losses are after the collateral has been taken into account. So these losses represent what would either have to come out of the DAI surplus buffer or MKR dilution. So as I said, the average of this distribution is what you almost assuredly should be prepared for. And then given that there's a lot of randomness and uncertainty in just various risk factors, such as the asset price or liquidations, you might have larger losses than you might expect. These are just quite simply called unexpected losses. And the upper limit of these unexpected losses is basically the entire DAI supply, right? If every single collateral type simultaneously goes to zero, then Maker has a shortfall of what the entire DAI supply is. And it's not really feasible to have the entire outstanding DAI supply in your buffer, either in the DAI surplus or in the expected MKR issuance or dilution. So kind of a rule of thumb is to just pick some cutoff point where you say, we can handle losses up to this amount, but anything beyond, well, that could be quite disastrous, right? And so there's kind of like a fairly standard heuristic for what this threshold should be. It's called the value at risk metric. Essentially, you choose a probability with which you're okay with the likelihood of suffering losses greater than this amount. So actually, maybe if you jump to the next slide, it can be a bit easier to explain. So the way to think about it is you would say, under normal market conditions, we are, for example, 99.9% sure that we will not lose more than some amount. The percentage or the confidence interval is chosen such that it's just extremely unlikely that you would suffer a loss greater than that. And then the goal would be to make sure that losses less than that can be absorbed, either by the DAI surplus buffer or the MKR dilution. So the goal is, so just to recap, you run a simulation, you create a hypothetical distribution of what your losses might look like. You pick a threshold beyond which losses are extremely unlikely, and then you ensure that you can absorb losses up to that point. So then the governance decisions become, well, what if the number that you've chosen is still greater than your buffer? So let's explore that concept for a bit. Next slide. Okay, so the sum of the Maker DAI surplus, the surplus buffer, which is currently set to 500,000 DAI, and your MKR issuance should, in theory, cover your value at risk or your VAR losses. So again, this would mean that Maker can withstand up to 99.9% of losses in theory. So to pick apart these two individually, the surplus DAI buffer is the first kind of line of defense that is netted against protocol losses. We saw this on Black Thursday. The DAI surplus was drained prior to the MKR dilution beginning. DAI surplus is likely to be the preferable form because it's literally the precise unit of account that you need to offset protocol liabilities or protocol losses, right? If there's a shortfall of 100,000 DAI and the protocol has 100,000 DAI in hand, then it just cancels out nicely, right? obviously there's this like trade-off between keeping DAI in the surplus buffer versus sending it to the surplus auction. I like to think about the DAI buffer as essentially pre-printing MKR. So if you think about it, you could wait for the market to crash, the protocol sustains a bunch of losses, and then at that moment, the protocol would need to mint MKR and sell it for DAI, or governance in the community could preemptively do that process, either by just collecting stability fees and just putting in a surplus buffer, which is, okay, so that's not technically pre-printing, that's just abstaining from the burning of MKR. But I think in theory, governance could actually preemptively mint MKR to raise DAI for the surplus buffer. There's some good heuristics for that as well. This kind of gets heavy into some corporate finance theory, like what is the cost of the trade-off between minting MKR for DAI at the current price of 300 or not. Just some fairly, I wouldn't say fairly standard, but definitely if any corporate finance experts out there, this is a super interesting conversation to have, although probably outside of the scope for today's call. There's also another few considerations. So, well, one is the investor. There's definitely going to be some politically contentious investor issues with the surplus, because any DAI that goes to the surplus necessarily does not go to the surplus auction, which is an issue that governance is going to have to wrangle with. At the beginning of the presentation, I referenced some decisions that are not really for the risk team to make. This is precisely one of those that I was referring to. It's not really risk's job to say how much DAI should go in the surplus versus how much should go to the surplus auction, although we can help quantify the sum of these two sources of DAI, so that at least from the risk management side, it's handled well. And then secondly, there's like potentially some game theoretic issues with having large DAI reserves. Governance needs to think carefully about how a large DAI buffer could be exploited or taken advantage of somehow. For example, an emergency shutdown, what would happen to the surplus buffer? How would it get distributed? Who's kind of who does that DAI rightfully belong to? What if I think the specific issue could be something like, let's say there's a catastrophic loss and now DAI is trading at a discount, and then potentially there's some scenarios where the DAI in the surplus buffer would not necessarily go to recapitalizing the system. So yeah, there's some kind of edge cases that governance should work through before just dramatically increasing the surplus buffer. Secondly, there's MKR issuance, right? We experienced this a few weeks ago in the wake of Black Thursday, right? And this is probably quite it's quite risky to at least depend on this preemptively, because even when the MKR price is say $300, which represents a market cap of roughly 300 million, I think everybody is well aware that you cannot actually mint 300 million DAI out of this MKR, right? Because the liquidity isn't there for that. So what is the true amount of DAI that could be raised in a MKR auction? Like, what is the absolute maximum amount? And actually, the first thing I want to say is that there is some maximum amount, and there is a hard limit to dilution. A lot of people not a lot of people, but from time to time I hear this idea that MCAR dilution is almost like an infinite money bag, where you could just, every time you have an issue, you can just dip your hand into this bag and reach out and create some DAI. And it doesn't actually work like that. So we need to come up with a methodology to quantify how much DAI we expect to raise from MKR. And that number is important because if we misestimate that number and we do suffer a loss larger than that dilution capacity, then Maker would, I think, effectively just be insolvent, right? And we'll discuss one methodology that we devised, I think, on tomorrow's call. Honestly, though, this is going to be like one of the few subjective components, because there's a number of different ways to estimate how much DAI can be raised in an MCAR issuance event, and that variance and that uncertainty is kind of what throws the favor towards the surplus DAI buffer, is just being much cleaner and easier. Are there any comments in the sidebar that, actually, I think at this point we should address the comments slide by slide, because so Akiva asks, talk about how a higher surplus buffer will attract more DAI buyers from hedge funds. Right. So I mean, the surplus DAI is definitely a more robust form of protection. It doesn't rely on investors coming to the table in a crisis. The community should feel very grateful and thankful that that did happen with almost no hesitation in the wake of Black Thursday. But that may or may not be a luxury that is always there. And so, if in terms of DAI adoption from large institutional buyers, conceivably they would want to see large DAI surplus buffer. Oh yeah, I forgot to mention one other game theoretic issue that I was considering is that I think it'd be kind of weird to have like a significant portion of the DAI supply sitting inside the surplus buffer. So imagine if there was 100 million DAI, but 100 million DAI outstanding, but 30 million of them were in the surplus buffer. I think that could kind of create some weird edge cases and potentially impact growth as well. So one kind of third idea that's not listed on this slide is some sort of on-chain reserve that is not DAI and is not MCAR issuance. Now this would likely wander off into kind of off-chain asset territory, and maybe that's not desirable and whatnot, but technically another option. Okay, so if there are no questions.
Can I chime in here a little bit on the surplus buffer thing?
Yeah, this is a time for people.
I'm not going to take too long either. So, because I advocated for surplus buffer at least 2 to 3% some time ago. So a lot of these points are pretty good. The whole point of having that surplus buffer is then it does remove liquidity from the market, so it kind of has a negative. But when times are good, you kind of want to do that. When times are bad and you have this kind of large-ish buffer, we can debate what large is. 30 million out of 60 million, 50%, that's pretty large, too much. But if you have something like 10%, then basically what you can do is during the bad time, you can actually go and buy Maker at a depressed price and release DAI into the market. And so it's kind of a clean mechanism actually or cleaner mechanism actually for liquidity removal and supply. And so having that surplus buffer and having that mechanism to do lots of things with it, I think is a good idea, really, and something to be think about. The level of it, that's a whole different, we can have that discussion. But I think this is a really important issue along with a number of other ones. And I think from that context, it's important. So I'm going to let that.
Yeah, so I think that the key theme here is this is where skin in the game governance is most critical apparent, right? This is where prudent risk management needs to take center stage, and people have to realize that if things go south, they want to be adequately prepared. And this is probably going to be the subject of many conversations, kind of the quantity of the DAI surplus buffer. A starting point could just be based off the loss distribution, but there's really a number of directions to go with this.
The idea of releasing it into the market at the time when we need liquidity sounds good. Like, that makes a lot of sense to me.
Well, and there's another bonus here. I mean, using DAI, I think, is good because of the liquidity thing, but there's an idea of having like assets in our surplus buffer too that we can manage as well. And so, you know, the other thing is that companies are valued on multiple things: assets, you know, revenue streams, the growth thereof or not, you know, how much debt they have. And the idea that, you know, we have to burn Maker to actually give it value, that's totally wrong thinking. I mean, ideally, you'd like to have the system, we want to have DAI moving in the system, and we would like to generate assets that the company has that represent value. And if it's only DAI, that's going to kind of suck because we're kind of chewing on our own liquidity to create value. But in some real sense, if we can think about it in those terms and then build an asset portfolio that isn't just DAI, that we can sell when we need to in times that we need liquidity, it creates value for Maker just from a general company valuation perspective metric that is used in all financial analysis. So we can build Maker value in a lot of different ways. We don't have to burn Maker to do it.
Yeah, that's a great point. Okay, so let's we have a few more slides to wrap up, and then we can maybe do Q&A at the end. I just want to be conscious of the time as well. Vishesh, do you mind going to the next slide? Cool. Okay, so now we're going to start talking a little bit about the three primary risk parameters. So the first one is the liquidation ratio. This is the obviously the threshold at which vaults get liquidated. So thinking back to that loss distribution that we showed a couple slides ago, the way to think about the liquidation ratio is that if you're requiring more collateral upfront, then your losses will be lower. And so therefore, if you're in a situation where your value at risk is larger than your total buffer, then you kind of have two options. One is you can either just lower your risk altogether by just lowering the debt ceilings and the DAI supply, or you can increase the collateral requirement. And so this is maybe this is one reason why such a high, I think a relatively high collateral liquidation ratio for ETH has been in production from the beginning. I don't know if this was the original reasoning, but if you think about it, the over collateralization buffer provides such a large buffer that the protocol losses are, well, as of a few weeks ago, were non-existent, right? So essentially, liquidation ratio can be used as a risk management tool to balance your losses versus how much buffer you have in your protocol. Couple of interesting notes. One is that a lot of people tend to think that the liquidation ratios are fixed, which they have been up until now, but there are some weird edge cases where liquidation ratios might have to be changed in an emergency situation. Of course, this is not a popular decision by any metric, but I think we need to start making clear that this is technically a possibility. And there's actually some precedent for things like this in traditional real world analogs, where in the midst of a crisis, collateral requirements go up, which tends to cause a lot of problems for the borrower. But you know, from a financial risk perspective, MakerDAO needs to think about the risk as well, and so that's technically an option. And then secondly, I want to talk about this meme that has been, you know, one of the common memes for the past several years of maker risk is that when assets become riskier, the stability fee should go up to reflect that increased risk, which is technically correct from a certain perspective, but an increase in stability fee does not offset your tail risk losses, which is really what you care about when you're talking about increased risk. And I'm not sure if that's something we can maybe make more clear after the call or something. Well, let's jump into the next slide. All right, the debt ceiling. Debt ceiling is the maximum amount of DAI that can be drawn against a collateral. Kind of the heuristic that we use here is that you want to set your debt ceiling such that the resulting value at risk is less than the buffer. You can do this just through some iterative stress testing, which is basically testing out higher initial amounts of DAI supply and seeing at which point your protocol has turned into a risky state. The increase in losses due to increase in DAI supply is not linear, because higher DAI supply typically results in larger exposure risk and larger liquidation discounts during the auction process. If you end up in a situation where your risk is too high, then again, you have like a few different policy tools. You can either increase your buffer somehow, or you can increase the liquidation ratio, or you would have to essentially just curtail the DAI supply so to lower your exposure risk. So there's like a few trade-offs here that governance should be aware of. Then let's jump into the last slide. All right, and then finally, the stability fee. Stability fee has a few different components. One is just from the monetary policy side, which is the DSR cost. And this DSR cost can also, of course, factor in the DSR utilization rate. But then the balance of the stability fee is what's typically called the risk premium. And this risk premium can be kind of subdivided or broken down in a few different ways. This is just kind of for ease of understanding. This breakdown isn't strictly important, but one way to think about it is to divide the risk premium itself into two components. One is compensation for your average expected losses. This basically says, if you already know you're going to lose this amount of DAI from a certain collateral type, you may as well bake in a stability fee that will just cover that one-to-one. And then secondly, you will likely, or governance would likely want to add an additional component to cover both the DAI surplus buffer and however much, when I say the DAI surplus buffer, I mean the opportunity cost of the DAI surplus buffer and any additional stability fee that would want to go to the MKR surplus auction. All right, that's the end of the presentation. So this is good time for Q&A, and anything else that you may want to discuss. Vishesh, I think you can cut the screen share as well.
Start by saying, like, appreciate the presentation, both of you.
Cool. Yep. And then tomorrow, and then as a preview, tomorrow's call, we're going to actually discuss all of the model inputs that go into creating those charts and graphs that Vishesh showed in his presentation. We'll talk about some of the methodologies behind calculating some of the risk factors and so on, with the ultimate goal being to create that loss distribution. And from that loss distribution, we can use a few heuristics to calculate our desired risk parameters. Once we do that, over the coming weeks, we can start, I think, well, there'll be and then I think on Thursday's call, there'll be a demo of this process applied directly to ETH, for example. And then in the coming weeks, we can kind of start messing around with the model and start applying it to other collateral types that we might be interested in. There'll be some documentation coming out next week. Vishesh will, I think, also be releasing the code along with some technical documentation next week as well. So yeah, I think over the next few weeks, with a little bit of governance work, we should be in a good position to start adding new collateral types.
Cyrus, I had one question. This might be something you want to get into in the next presentation, but do you guys take into account potential like technical risks and how that, like, do you factor that into the like all this loss distribution stuff?
It depends what you mean by technical risk. So technical risk at the collateral level, we do. I mean, we do our best to factor in a premium for, say, if a token has very poor solidity code, or
Right.
if kind of the underlying protocol is unsound, or maybe you have like a really awesome and competent team, but the platform is like 30,000 lines of solidity code, right? We do attempt to bake in premiums for these kinds of things.
I guess I meant more auctions, thinking about the recent history. But
yeah, I mean, for the auctions, we also attempt, I mean, we have like there's a parameter for factoring in, we call it auction efficiency. The issue is the calibration of some of these parameters, right? It's can be quite difficult to determine what the resulting loss from such an event might be. But yeah, we definitely can, and this is definitely a great subject for like ongoing research.
sweet.
Long for Wisdom, were there any comments from the sidebar that maybe are worth calling out, or?
There's probably a few throughout the presentation. Most recently, we were just discussing the surplus buffer some more and trying to figure out a way to actually set that higher, or get consensus on setting that higher.
Right. So here's one interesting thought for the surplus buffer, is that if it gets set significantly higher, right, it's not actually going to get filled for a while, and that's kind of
exactly.
that's kind of one of the tricky things there. And so there's a few options for that. One is to preprint MKR to fill the surplus buffer, although that's something that would, I think, definitely require a significant amount of technical work, and I'm not even sure if that's even desirable or not by the community. But another aspect is for governance to start thinking about the DSR spread as well as a means for more rapidly increasing or filling the DAI surplus buffer bucket.
Yeah, I think at this stage I'm kind of I guess, less concerned about how it's actually going to get filled up in the short term, and more just like, I feel like we should have a good target for it, and then just let it fill up. Maybe, I don't know if there's any like a good way for us to like speed up filling it. Don't know. Need to think about it some more.
I think Rich is gone, so
I was just gonna say one thing about, selling Maker to buy DAI. You're already going to put pressure on a market that's illiquid in DAI. It's kind of not a great option right now. That I'm with Long. We should just set a number that we want to get to. But the idea of like hitting the market with a few million more worth of DAI on Maker just doesn't sound appealing for lots of reasons right now.
I think Rich is gone, and my threshold for awkward silences is significantly higher than his. So I'm going to let this go for a couple minutes, let people figure out their questions.
Just do the Rich, barring any other discussion, we'll leave it open for a few questions and close it out. So give them a minute or two to come up with a few and let it go. So. By the way, I want to say great presentation. Definitely, just looking at it in this format kind of gives everybody some food for thought, and there's some pretty important names in here to think about it. So great presentation. Thank you, Cyrus.
Okay, thank you. Thanks, Vishesh. Yeah, okay, so does anybody have any input or comments on either on value at risk methodology? Because that's kind of an interesting one over the past couple decades of financial risk management, right? There's kind of like a standard way to do risk, and then a lot of people tend to say that we should.
One thing I was going to say, I put this in the sidebar, was start a thread on this, just the risk, and post the link to this presentation. And then, I tend to work better asynchronously instead of having lots of people listen to me while I think out loud. And so I think this is a really good thread to actually just start up a discussion, because we can talk in there about the surplus buffer. And so it would just be nice if the risk team actually started a thread on this, and we all could kind of chime in. Certainly we're going to have another meeting tomorrow. We can talk about it then. But I think this should be an ongoing discussion versus kind of let's just deal with it in 3 days and we'll come up with our model and move on. I think this is going to be an ongoing topic. And so it would be important to actually have a forum thread started on this with links to the material.
Yeah, I agree. And I think I'd like to see maybe like, I don't know what the community's appetite for this is, but an additional weekly governance and risk call. I don't know at what point the mental overhead becomes too high, but right. I mean, I think we're able to accomplish a lot if we could just band together and spend more time doing this. So I don't know, kind of a Rich and Long for Wisdom question, and a Charles question with respect to
in the absence of Rich, maybe I'll complain on his behalf, about the whole splitting discussion and things. But like, I actually think it's quite a good idea. I would suggest. So I wonder whether like weekly might be maybe a little bit too frequent. Like maybe we want like bi-weekly or something. Like it'd be kind of good if we could have if we could figure out like another meeting to fill the other slot of the bi-weekly thing. So we have like a risk and governance meeting, and then we have one other meeting which alternates between like 2 topics or something.
Well, I was going to say, don't we have to have that go with the cadence on whatever we're going to do with the system changes, liquidation, all the numbers, debt ceilings, SFs, all that jazz. I mean, we need something. It doesn't have to be an hour, though. I mean, we present, the DAI peg, and I literally want a liquidation report, but most of the time that's going to be like not much happened. I think it's a good idea. I think it could be a short call. And we should just match it to the cadence of the votes that we're going to have on this stuff.
Anyone else have any thoughts on adding an additional call?
Yeah, I would love an additional call going over this stuff more specifically. This is really fun.
Cool. Well, we have one more tomorrow for sure, and then we're going to actually wrap this up on Thursday, and then on Thursday we can maybe discuss the schedule going forward.
And if you're going to start a thread, Cyrus, I'd be curious if you have any resources on the like qualitative risk assessment for collateral types. I'd love to look at some of that stuff.
Yeah. So we have a number of talks coming out next week. We're just kind of putting some final touches on them. So yeah, we will. Sorry.
Oh, you're good.
I guess one piece of wish list for the guidelines for new collaterals is that I'm working on this accounts receivables, and the problem I have is the poor availability of data sets when it comes to default risk and volatility. So from this perspective, my expectations would be that the guidelines and the various models consider that quite a few collaterals that that are very good candidates for helping balance the system and make the and reduce the overall correlation between prices of assets, is that some of these collaterals have very poor data sets and markets that are proprietary and so on. So having these guidelines and risk models applicable in those situations would be my success criteria, how and maybe some growth hacks around solving these problems, because that's what I think the issues with one approach that is recommended is that it's not going to be applicable in many cases. So how we're going to deal with that, that I would like to see in the coming calls. Some advice.
Actually, that's a great comment. I'm glad you brought that up, Renat.
Both risk assessments, analysis, mitigations, and overall data sets and studies when presenting this collateral to the community, right? How do we go around the limitations that this particular collateral brings you?
No, I was just saying that I'm glad you brought that up, because I had this issue of what data do I throw into my liquidation analysis? And there's issues with getting this data. Like most of the places I was looking for buying feeds from or whatever, just data sets, you can't distribute them to other people. There's restrictions on what you can do with them. So the question is, how do we as a community deal with the data sets that are related to the collateral types that we're dealing with? How do we make those generally available to the teams and all kinds of stuff? And so, because I was just really having a hard time with getting data for my analysis.
Right. So to answer Renat's question, yeah, I mean, when the risk team set out on creating a risk tool for Maker, we definitely targeted collateral types that are public and liquid and have market prices and have a little, they're a little bit more tractable. We also tried to keep it as modular as possible. So, I mean, it'll kind of depend asset to asset. But I mean, to the extent that we're dealing with well understood, but maybe not crypto friendly assets, I think we'll just have to take it case by case, right? I mean, this is partly the need for multiple risk teams. This is partly why, or this is mainly why things like the MIPS process were created, so that we can create an avenue for people with high quality collateral that may not be able to be simply evaluated by an existing risk team, we create a structure that somebody else could come in and pick up the work there and submit to governance. I mean, all I can say is like, it has to be a case-by-case basis, at least in the early days, right? So, you know, you can try to check out the collateral onboarding MIPS and maybe submit some information about the collateral asset from there, and then kind of interface with obviously my risk team, but with the community as well, to come up with like a clean solution. As best we can. Right? I mean, we can't just plug any random asset in the world into the same model.
And understood. That all makes sense. It's just I've been thinking what could be the solution to this, and so far I arrived to just one interesting workaround, which is the debt ceiling. In many of these cases, right, they go to market. There are some collaterals that already have a strong origination capabilities, right? And then there are types of collaterals that are new in the market, right? And they're just bootstrapping their demand side. And so in both of these cases, but more so with the second type, they don't necessarily care about how big the amount of liquidity they can access, right? But the fact that it's there and they're bootstrapping their entire demand side is is so much more important. So what leads me to a conclusion is that imagine we have a sandbox for collaterals, right? Where the collaterals have much less strict requirements for various types of maturity of their pieces, not necessarily the technical pieces, right? But like risk models and studies and so on, right? And given a very small debt ceiling, and let the data accumulate, right? And let the time work to our advantage, where we can accumulate the data sets and observe, and using this sandbox with a small debt ceiling, we could lower the barriers and the threshold of how much work it really takes to bring new collateral on board. Because if you really need to get to the existing players in the market in order for you to get this data set, and they're not willing to because they may have some conflict of interest or not interested, right? We basically will be cutting ourselves off of the collaterals that are really, really uncorrelated and have good qualities, right? Just because you couldn't get through the two parties in the marketplace which have the data sets. So that's kind of what I've been thinking about, is to use this debt ceiling and create some form of sandbox. Does it make sense?
Yeah, totally. I guess we're just getting started, right? So yeah, these are the kinds of tools that we'd love to see, and we hope that we can start producing some infrastructure to handle a broad range of kind of data testing and so forth.
Mm-hmm. Great, thanks.
All right, we're down to like 18 participants, so maybe
All right.
this is a good time to
Okay,
end, unless anyone has any more questions or anything.
Nope. Thanks a lot, everybody.
Mm-hmm. Thanks. Bye.
Hopefully.
All right, thanks all.